Okay. So today I want to really dive into, what my personal portfolio looks like and kind of how that each piece of the portfolio itself has a very specific job that it has to go accomplish. So let me share my screen here and kick things off. Okay, cool. So hopefully everyone can see my screen here. Cool. So again, right, the focus here is that every part of the portfolio itself has a job. This is a portfolio that I personally live off of full time, right? This is what I live off day to day and kind of how each piece is constructed here too. So to cover kind of some background, right? I started out where many of you may be in kind of different parts of your journey as well too. So I started in tech sales, right, from the bottom of the totem pole, right, when looking at being an SDR, where I was, you know, cold calling, right, writing cold emails, using LinkedIn a ton, and over that period of time, worked my way up into a more senior leadership role. Right, kind of the biggest organization I had with me was at LivePerson. The stock went on a great run at the time to about 120 people globally across the board, and that's where a lot of my focus was. And the stock, I'd say don't look at it now, but in the time period I was there from 2018 to 2020, so you can go look at it from then. And my last 4 years, my career were really good earning years, right? And those earning years set me up where I had a lot more capital to go deploy, right? And those were kind of 2 years of LivePerson, 2 years at a company called Prometric, where I ran division of sales. But if you look at it, right, I was still trading my time for money, even though it was good money at the time, right? So those are things to think about too, is that even if you're in a great spot financially and have a great role, right, you are still physically trading your time for money. So today we're going to dive into how money actually works for you and how to go give it certain jobs. So when I really first started out, I didn't really know a lot, right? In turn, my thought was that, hey, let me go buy some rental properties, right? Single family homes. And it taught me a lot, right? It taught me how to go underwrite deals, how to go think about cash on cash returns, how leverage can be your best friend or worst enemy, right? And the tax advantages that come with it in terms of how, depreciation. But there were certain things that made it just not a great path for me. And that's focused on I'll tell a story first actually. So the second I knew it was done for me in this space was that we had kind of our board meetings coming up for that quarter, and we had to go prep all of this stuff for our CRO, right? So they can tell the story of our team. And I had a tenant who drunkenly drove over their sewer line with a lawnmower. Didn't know that was possible, didn't know that was a thing. I sure found out. And in turn, that cost me both money, a lot of time, a lot of headspace. Yes, I had a manager manage the properties, but things like this don't get contained. So what I found out really quickly was that each transaction was so time consuming that it was just a huge lift overall to go do it. So eventually kind of pivoted from there, right? And really good first experience, but I realized that it was just not what I wanted to go do long term, as the opportunity cost itself versus work my day job was very expensive to go do. So here, there's just a simple math around it, right? When we think about what do we actually have to get to, and the point I want to make here too is that if you're looking at investing passively into deals, into building a portfolio for yourself, into stocks, bonds, real estate, private deals, etc., right? You likely need a lot of money to go do so. And what I'll show you here is if you're looking at different goals, right? On the left side, we have the income per month that you need, right? Income per year, and going to, right, you have based on different totals in terms of how much you can go draw down, right? How much money you actually need to go achieve those goals. And this is a huge variance, right? And what you'll see, the most important thing here is that if you look at, say, the S&P, we were generous, we gave it 5%. Usually it's the 4% rule when looking at how much you can go draw down in your portfolio itself and still kind of have that make it through retirement. On the right side, we have private credit, right, which is effectively lending across the board. And what you're seeing here is just how much more lucrative on a cash flow basis that lending and credit can be versus right? Things like the S&P 500, I'm looking at yield to go live off of. So have your number, understand what that looks like, and you can kind of start backing into things like this here too. So my journey, right, we've done now probably close to 100 deals across the board, across every asset class you can think of, right? Real estate, private equity, private credit, debt, and then every asset class in real estate you can think of too, right? So we've helped deploy about $120 million or so far, right? We've had a core focus in three vehicles being, right, private credit, private equity, and real estate, and we have taken zero capital from institutions to go get there as well too. And, I think sometimes people have this thing where they're all in on one thing. And I'm slightly that way to a certain point where I'm all in on private deals. Those private deals themselves can be across real estate, private equity, private credit, debt, all these different types of things that are not publicly traded, right? And what you may see too is that, if you're all in on real estate, you likely have no liquidity, right? Real estate can be great, but there are downsides to it too, like liquidity. If you're all in on stocks in your 401k, for example, right? It's a very long time horizon, right? That's intended to have you working until you're 60 years old, right? Working for someone else and kind of letting that grow while you're working that time period too. And then if you look at the other side of it too, of having money in cash or savings, right? It's great to have liquid capital. That's a part of my portfolio too, which we'll cover, but you're losing money to inflation and that money is not working for you in a way that it should be. So when thinking about how each piece of the portfolio has a specific function that it's serving. So, right, each piece has a job. So when looking at cash flow, right, cash flow keeps the lights on. For me personally right now, what we're building, I'm taking very little, if any, cash out of the companies that I'm working with right now. And in turn, I'm leveraging my own cash flow from investments to go help me live, right? So you have that as to help keep the lights on. Part of your portfolio can be focused on growth, right? And that growth component is really focused on building long-term wealth for capital you may not need for a long period of time, right? Third is tax efficiency, right? A lot tied to real estate here is the goal is keeping more of what you actually earn. Next, looking at liquidity, right? This is a component of having access to cash when you need it, right? So I say, having cash is one area, but having access to cash quickly is also a big piece of the portfolio as well. And I'd say the last component, right? This is a big swing type scenario where it's a small piece of your portfolio where if it hits, great. If not, you can live with it. And again, here is actually my full portfolio breakdown of how I think about it. I'll break out kind of each part of this too. So 37% in private credit. For me, in my area of life right now, private credit's a big piece for the reason that I need the cash flow because the businesses I'm building, by taking those bigger swings in those companies, this then allows me to go live a certain life that I want to go live in terms of yield. So that's a big piece of it, right? The second biggest component is real estate. And the reason is that for me, that's a massive tax haven, right? When looking at the benefits of coming with real estate as well too. Private equity is, more so investing into larger businesses. SME companies are kind of companies we own ourselves directly. About 5% of my capital, my net worth is in cash. And I've got 3% in Bitcoin where if it hits, it hits. So let's going to break down each part of the portfolio and the goals around it. So private credit, right? My portfolio is between 10 and 16% in terms of yield in private credit. And the reason is, again, is this is focused on current yield. So these pay, most of them are monthly, right? These are shorter lockup periods too. So I look at this as cash adjacent when kind of looking at having capital. Because I know that, hey, once this is here for a period of time, I can go draw it down when I need to. So for me, that is super helpful to have access to those dollars, not tomorrow, but pretty quickly. So that function there is, high likelihood of success, high yield, and also access to capital when I need it. So next, looking at real estate, right? This is a big component too, right? And less so in single family homes, much more so in mobile home parks and multifamily. And the reason here is that depreciation can help offset other income, right? Through things like cost segregation. You're also owning a tangible asset, right? So when you think about the inflationary environment that we have in the last handful of years, owning things that have, actual hard assets is always good, right? This is a long-term hold when looking at these types of deals. And again, these are things that we plan on holding for a very, very long time and a great hedge against inflation here too. So when you look at private equity, I view this as, things like a roll-up play, right? We're working very heavily in the paving sector right now ourselves too, and we have a lot of our own cash in the game as well too. So, we look at boring businesses that cannot be replaced by AI, or very much so more resistant to AI, right? So if you think about it, for example, paving, you're not going to go have AI go start paving roads or filling driveways or fixing parking lots, right? We want to see industries that are fragmented. And what I mean by fragmented is that you want to see a really big spread between the smaller companies and the bigger companies. You don't want to see some conglomerate, right? So think Amazon. You think of e-commerce, Amazon is a monster. They dominate in that space. In paving, you do not have those same types of scale. So we love this space. There's other spaces that are like it as well too, that have opportunity to go acquire companies at low multiples, right? Go bring them all together. And then in turn, the goal there is to go exit them in kind of one lump sum. And again, these are real cash flow, good multiples they're acquiring them at too. And something I always look for is that you want the operators that you're investing with in spaces like this to have massive skin in the game. And what I mean by that is it's twofold, right? So the simplest one is they have to have cash, right? Cash is a big component of it. But the more important one to me is that this is a reputational type thing. This is their focus in terms of their time. So you want them to have massive skin in the game in terms of both their upside, their cash, and their time going into a venture like this. So SMB companies, I'd say these can also be similar to private equity type deals. These are more so companies that we likely don't own with investors. These are things we own ourselves, right? For example, I own an accounting firm with a partner, right? And the intention here is like, we will own this company for a very, very, very long time without investors. So that's the intention around is, do you want to have control of this? We think they're durable, right? We think it's AI resistant. For the most part, we're looking at the accounting space too, is only something to go sign off on something. But there are a lot of different opportunities like this to go own parts of companies for the long term. And there's upside still too here, right? This is good for cash flow, it's good for durability, it's good for a long-term approach. But this is something that we plan on hanging on to for a very, very long time, unless we get offers that we'd be foolish to go say no to. Cool. And then looking at cash, I think this is a big component here too. Is when you go out and you leave your corporate role, right, cash becomes a bigger part of the equation, right? When you don't have those biweekly paychecks, monthly commission, quarterly bonuses, right? Having cash is your safety net. This allows you to go, you kind of think about it in like a runway standpoint, right? If you have, $1 million and you spend $20,000 a month, like, okay, I've got a little over 4 years of runway to go work with, right? So that gives you a lot of optionality to go think about it. Is I'm not forced to go do things in the short term to go operate, right? So cash is always great to have liquidity, right? In terms of things pop up, it's great to not be forced to make bad decisions, and you can move quickly when deals pop up as well. So cash is a smaller part of my portfolio as a percentage, right? 1/20th, but I view the private credit component as a great place to go park capital that I can have access to in the future if I need it in not that long period of time. So maybe I'm only solving for 3 months of liquidity versus solving for 2 years because of how the private credit itself is structured. And this one, right? We've got 3% here in Bitcoin. The reason is that it's super small, right? For me, how I view this is that if this thing hits and people like Michael Saylor are right, and this thing's worth $2 million a coin at some point, great, I'll be happy, right? Maybe I'll buy a house in the future with that. But it's something right now that if I lose all of this and it goes to zero, I can go live with that and stomach it. So maybe it isn't, Bitcoin for, maybe it's venture, right? Or things like that, where that the likelihood of this panning out in a huge way isn't as high as other areas. But if it does hit, right, that pop, because of how big that could be as a percentage, could be very, very massive as well too. So this may be venture for you. This may be things like Bitcoin. This may be things like other crypto, right? Things that wouldn't go put the whole house on, but you feel pretty comfortable that you've got a shot here to go give yourself return that is asymmetric versus the risk you feel like you're taking. Cool. Now looking at the full system again and kind of breaking down each component of this. So one, private credit, right, being cash flow. This is the income that funds and feeds my life to go live, right? Real estate is the tax shelter that depreciation allows me to go live more efficiently because of that. Right? Private equity is the growth, right? That is patient, that's decades long. And then you look at it as that cash can be pumped into things like SMB type ownership, right? Small business ownership. And the reason is that it's harder to go deploy big checks into companies you own yourself because they're harder to find. They take longer to go build, right? So kind of allowing yourself, those are great upside potentials when you have them, but you can only have so many of that too when looking at the portfolio itself. And these can be things like backing a search funder as well too, right? Can kind of fall into SME ownership type category. Cool. And when you look at the cash flow component, I think this is one of the biggest things. If you take a step back, like when I saw, right, when I was at a company called LivePerson and we'd go to the office in New York and I was at the time 23 to 26, right, when I was there. And you go look around and okay, the people around me, maybe one level, two levels up, like would I go trade places with them? And the answer isn't fuck yes, it's probably not, right? And you see how they live, you see what is in their time, what they're doing, right? The risks they have with all their stuff being concentrated in their day job. Because you think about it, you have your base salary, your bonus, your commission, you have your stock option, all those things. So you're very concentrated in that one company. So you have both a risk in terms of company and risk in terms of your ability to go keep working there. So when I look at the cash flow component, this gives you optionality to make decisions based on what you actually want to go do and giving those choices to really build things as to how you want. But I think it's more importantly to build the ability to go say no to things you don't want to go do, say no to things that you don't believe in or things you don't want to be a part of. So I think this is the biggest piece of it is this freedom allows you to go start thinking bigger and thinking more intentionally about what it is you want to go do and build. And for me, at least, right, the sequencing was building cash flow first. That allows me the opportunity to go think about, I can go cover my baseline. I can go make decisions based on what I want to go do. Then in the future, once I have that covered, I've now bought my time back that I can go grow from a place of stability. Right? When you build a business, for anyone who's listening here who's built a business or a partnership or whatever it may be, what you may find, at least what I found, was that you're working disproportionately more in the start versus what you're earning yourself or taking out of the company. If you want to go build things the right way, cash flow allows you to go do that, right? It allows you to go think really big and allows you to go focus on the long term. So if I didn't have that cash flow in place, I couldn't have built what I'm building today because there are periods of 6, 12, 18 months where we're not making any money. And in turn, that cash flow itself allows you to go have that luxury of swinging bigger and building something that's actually sustainable long term, whether it be for an exit, whether it be for cash flow you're not working there, right? So that cash flow itself is massive to be able to build the right way. And I think this is a really important piece too. Like, what can go wrong, right? So think when you look at, chasing yield, right? You'll see 3 deals in front of you, and like this one has the highest return. Great. Understand the actual structure behind that return, right? Duration, risks, right? Where in the capital stack you are, all those things you have to understand to see is this actually a good deal versus this is higher than this. So a lot of things we've got to understand with that as well too. We have a lot of content as well as how to go vet, qualify, underwrite all these different types of deals that you're seeing to make an educated decision. Right? Illiquidity. So there's a price for illiquidity. I think I did a video on this last week where if you don't have access to your cash, right, you need to be paid a premium for it. So understand that, hey, if I need cash in 2 or 3 years, locking up for 4 or 5 or 6, probably not a great choice. So understanding kind of where you're at and what you want to go do, and I'll cover different types of personas here shortly based on other scenarios that people may be thinking about. So over concentration, this is kind of a double-edged sword, right? Over concentration in one asset class is definitely something good to go look at of having a level of diversification, but don't diversify just to diversify. Like don't get worse for trying to diversify, right? So if certain things are working, maybe stick with it. But I think it's always important to understand the risk concentration you have if all your money is in one certain area or if all your money is in, one given market or asset class, whatever it may be. And I'd say lastly, this is a really important one, especially if you're in a big city. If you're in New York, if you're in LA, right, and you're in a super high tax area, that understanding the tax structure investments you're making, right, and your income itself is a huge piece, right? It's not just what you make, it's also what you keep. And now kind of how to think about your own allocation, right? You think about it as, okay, do I have enough to actually cover my baseline? For me, there's understanding, can I go live off what I have? And then factoring my runway, right? That's a really important piece to go think about it is, what your baseline is, unless, and we'll cover it here soon, you're like, I want to keep working in my business, my corporate job for a very, very long time. That's totally fine. Your goal is to make shift. Also looking at your portfolios, does every dollar I'm working with have a clear job? Those jobs can be different and those jobs can shift based on where you are in your life, right? My personal portfolio, right? If I fast forward 10 years in the future, will likely shift more so out of current cash flow and then shift far more so into asset protection, right? And the reason just be kind of where you are in life. And so never a wrong answer, just more so specific to actually your section, your kind of your stance as to where you are in your journey of life. And then thinking about tax structure, this is super important. Again, like being able to go keep it, being able to go understand like the benefits of it. Oftentimes you'll hear people, pitching real estate deals, saying it's a great tax play when maybe it is, and maybe it isn't for you if you can't use those benefits. And this is kind of, if you're doing an analysis, if you're looking at your portfolio, if you have a financial advisor, if you have a spreadsheet you look at, right? Go map out all of your money, all of your net worth, right? Any way you do it, great exercise to do it, track it, look at it frequently, measure it's getting better or getting worse, right? Healthy or more sick. And when you map it out, understand the actual function each dollar is having and what job you want it to go have. And if those jobs aren't aligned to where you are, go fix it, right? Go reallocate things. Go make sure it's aligned with who you are right now and where you want to go. Number two, this is a really important thing when looking at it. Having the cash flow piece of it to go cover your baseline is so crucial because that buys you the optionality to go think way bigger, way differently, way more long term. Again, three, right? Now that you're making good money, you have investments, right? How do you go keep more of what you earn? This compounds in a big, big way. And I'd say lastly, looking at is how to go grow in things that you may not need for 10, 20, 30 years. That's where real wealth can be built overall. And everyone that is in a different spot, right? I want to go talk through 4 different types of personas that, if you're listening to this call right now, this webinar, you may feel like you fit in one of these, 2 of these, 3 of these, none of them, but I wanted to make it really clear as to different types of people so you can have a baseline of what to go think through. So let's look at the corporate climber. And the reason this role is really important is that if you're in a corporate role or if you have a business that you love, right? And you're like, this is what I'm doing in the next 10, 20, 30 years. Your positioning may shift from somebody looking to go leave their job tomorrow. So in turn, you may focus less on yield and more on overall return if you think you'll keep staying there and have a great, income, job, all those things. Because here, right, that corporate person, taxes are a big piece of it. So if you can optimize for taxes is a really big piece, is a really big component, right? You can have a long runway because you're fine with the liquidity. Like if your time horizon is 10, 20 years of working, locking money for 10 years, you may not care about that, right? So if you're okay doing that, you may have more options for overall better returns potentially if you're okay with that illiquidity premium. So when you look at different sequences, right? Private equity, as an LP, private credit, real estate, right? S&B in terms of kind of that hierarchy where you go to. So next, this person, this was me the second I got into corporate, like I want to go leave. I have no clue what I want to go do. Let me go figure out how to make the most money possible so that when I do leave, I can go figure it out and move quickly. So you may have a high income job that you plan on leaving. So you have an expiration date here as well. You need to go replace X every month in income before you leave to feel comfortable, right? So every decision you make has urgency behind it. So when you look at it as your sequence, you're focusing likely on something like private credit or private lending. And the reason is that distributions are higher. Therefore, you need way less capital. If we go back all the way over here, where is this? Right? You need way less capital to go hit your goal of how much you need to go leave your job. And it's substantial. So go back to the slide when you look at it and go kind of walk through that again. So that's a really big component of it too, is that you need to optimize for yield, figure out the gap today of where you're at and where you need to go. Then once you're in that place, looking at tax savings, looking at growth assets, right? But the first priority here is figuring out how to go replace your income. Next is the business owner. And this is someone I think of, right? Could be a great business, but it's lumpy, right? We see it in companies we own ourselves with their seasons. Right now, for example, we own an accounting firm. Tax season, right? A very good income. There's a big slowdown there for after tax season, right? Just because that's how the business actually is. So there's certain companies that have a level of seasonality. It's bumpy, right? There's up and downs. There's periods of growth, periods of contraction. So having some level of high yield is super helpful, right? Tax savings is really important, right? Kind of helping smooth out those bumpy periods. But again, also, if you're a business owner versus W2 employee, your cash reserve likely is higher. I know for myself now, leaving the corporate world, I keep way more cash as a total amount on hand or access to cash than I did when I was in corporate when I knew I had a paycheck coming in every 2 weeks. And this is a capital allocator. This is someone who is getting to the place, has the capital already, right? Maybe they have a big IRA, maybe they have a big 401k, maybe they already have had their exit in some way or made enough money where they can go truly become an allocator. This person, you're focusing on really auditing your systems, right? What's there, what's going on, what job is every piece of capital I have doing, going through the gaps, the cash flow, the tax, the growth, all those components, and thinking about tax strategy, right? Thinking about how to go, what your next 5 years, 10 years look like. So this is more focused on reallocating and planning than it is on growth. And what I'll leave you with before I open up for Q&A too is, stop looking at it by asset class, start looking at it by purpose when you diversify. And again, cash flow funds your life, growth builds long-term wealth, tax efficiency allows you to go keep more of what you earn, liquidity allows you to stay ready, and asymmetric bets allow you to bet small but really win big. So I'll stop sharing here as well and kind of open it up for questions from the audience. These can be questions on anything, right? In terms of deals, allocations, right? All those things. So feel free to go drop some questions in the chat. Cool. Hang on for a few people with questions. If not, we'll hop off here early. Okay. We are seeing some questions come in. So I've seen a lot of questions come in. All right, we'll start at the top here. So first question, I have been hesitant to lean into private credit because of tax implications. Can you speak to that? So this is a really important point, right? When looking at private credit, I think it's one of the best vehicles there is, right? Personally, I have a big piece of my portfolio there. It is the least tax efficient investment you can likely go make. It is likely to be taxed as ordinary income. So you have to go see is that, hey, is the yield high enough and the liquidity premium you're paying high enough to justify the after-tax piece of it? So if you're getting, say, 12% and you're in a place you're paying 33% tax, your after-tax rate is 8% then in terms of your yield. So you have to go factor in that 8% after tax worthwhile for you. So yes, it's the highest tax component that there is, but it likely has higher yield to go justify the higher tax and the liquidity as well too. So that's why I think about it is the after-tax itself worth it when looking at the total return that it gives. Cool. What's a good amount of net worth for someone to have now to get started? So it really depends on what you're doing, right? And kind of how you're looking at allocating. If you're someone who's probably, worth 100 grand, right? Probably hold off on a lot of things. If you're worth $500 million, or if you have very high income coming in every month or every quarter, right? Allocating becomes easier. So what I would just say too is like you don't have too much of your concentration in any one given deal where that deal itself can keep you up at night every single night, right? So I'd look at it more so in both the mental and the dollar amount, where if you make an investment and it's start small, and if that small investment relative to the deal itself is going to keep you up at night in a big way, that may not be worth it for you to go, allocate those dollars to there. For these investments, are you investing in funds? So yes and no. So all my investments personally are they're all in private deals, and the private deals are either structured as private debt, funds, or syndications, right? A fund and syndication, the big difference, I've done some content on this too that I can send your way on our YouTube channel. The big difference is that in a fund, usually it's a blind or semi-blind pool where there's more assets in it than just one. In a syndication, like a real estate deal, right, you're usually investing into one asset because it's big enough, right? In our credit fund, for example, we have roughly 100 different fundings in that fund itself where your money is diversified across all those different types of deals in the fund itself too. And they're also just too small to do one off. So what I'd say, it depends, but I'd say a combination of both all private deals, but a combination of both syndications and funds, depending on both the asset class and deal structure. What tools, process, company to use to source acquisitions? So luckily, we've been in a place, at least myself, where we get more deals brought to us than we can go fund ourselves, right? So if you're starting out and you're looking at to go buy companies, or Alex, could you give some context? So you're looking to go buy companies yourself, looking to go back someone buying a company, kind of what does it look like for you? So we'll let them answer quick and we'll go hop to the second question. Okay, seeking roll-up deals to go buy yourself or to go invest into. So on the roll-up side, right? I mean, there's all things you can go do, right? You can go work with brokers, you can go work with, um, honestly, a lot of cold calling, a lot of direct email, right? Is great. I think also once you buy your first company too, it becomes a lot easier to go network with other owners there as well. So I'd say it really depends, but I mean, definitely a lot of cold email, cold calling, right? Making good relationships with brokers as well too is really crucial. Can you share the table again that showed the matrix of cash flow being collected from private credit? So I'll share this with you after as well too in terms of the diagram. But when I think of private credit, right, you know, on the institutional side, right, you're probably in that 10% range, where in the more, smaller market side like we're in, you can probably get more into the teens. We're kind of looking at yield as well. You can kind of go back into those numbers that you need to as well too. So I'll share that with you after we get off here as well. What kind of deals do you have in private credit, real estate, and private equity? So in private equity, I'd say the most capital into a role of what we're doing right now in the paving world. We have investments into a construction company, into an accounting firm we're active in today too. On the real estate side, I invest in everything from single family, multifamily, mobile home parks, RV campgrounds, storage, debt. I think right now my two favorite asset classes there are one, mobile home parks and RV campgrounds, kind of tying them together, and then two being multifamily in the future as well as deals stabilize. Then private credit, right? I have the bulk of actually my money in the space into my own fund in all focused around the kind of small business working capital type fundings as well. Okay, a question here. Are you actually looking at private credit deals and investing into them directly, for example, trying to engage the portfolio mostly passive, or is it hyper reacting passive? So I'd say mine is probably two-thirds plus passive, right? The ones that are more active are kind of um, more short duration, one-off like gap type loans that are more um, one-off and sporadic, right? Shorter periods, but the bulk of it actually is in my fund when looking at the private credit component of itself. Okay, so question looking at, are you using a fund to fund Reg a Reg CF and raising capital? So on our end, we work really primarily two deals right now, right, being the paving roll up and the private credit fund. Both of those are a Reg D 506C on the active side of the house. Cool. Any other questions, people? These are great questions so far. Okay, we have a good one. I'm in the escape artist phase, trying to drive cash flow from to get out of W-2. A good majority of our net worth is locked up in the IRA. We have most of it in a self-directed IRA that is invested into private deals. Curious if you would include it in your monthly cash flow number or you have transferred out. So I would not look at this as a cash flow number because depending on how old you are, right, if you can't go draw it out, that is not cash flow. I view that as a great growth place to go have in terms of investments. But if you cannot live on it today, that is not cash flow to me. The alternative you can look at here too is it worth paying the penalty and the tax to go get it out? And does that get you to your number? Because if it does, that may be a case for doing so, right? If you're like, hey, we're at, you know, 8 grand a month, we need to get to 12, and we have $4,000 locked up in this area. If we go, take it out of our for self-directed IRA, pay the penalty, pay the tax, we'll still cash for that 4 grand. Maybe if it's me, if I'm doing that and I want to leave very badly, that may be appealing to do so to get me there more quickly. Otherwise, say you're 40 and you have to get to 59 and a half, right? That cash flow then is not cash flow at all. That could be a great pop for you in 20 years, but right now does not help serve you. So cash flow to look at is like, can you go live off of it today? Cool. These are great questions so far too. have you ever lost principal in a deal that's gone south? So I actually recently sold a deal where we lost, a few percent on it. We actually, the sponsor actually asked all the investors, hey, do you want to um, sell this deal early and take a small markdown? Or do you want to go hold on to it for the next 3, 4, 5 years and potentially break even? And everyone collectively voted, myself included, to go sell early, right? So in turn, we took a small markdown for it, right? But had capital back to go redeploy. The thought process there on, both my end and the investor's end too was that, hey, if we can't go, if allowed us to go right to get back to the place of break even and it's this many years away, are we more or less confident that we can go redeploy capital and go make those dollars back? So yes, small amount, but it was something that everyone collectively voted on to do so as well. And then what's indicators or in funds you're investing into nowadays? For me right now, I invest almost all my money with myself, right? In terms of our private credit fund and paving roll up, kind of one-off deals I do personally. Depending on what you're looking for, right? Kind of what asset class you're looking to go invest into. You're looking at say multifamily, right? Lone Star Capital Real Estate is great. I know the guys there very, very well, right? Really good people. There's the operators in mobile home park class I really like as well too. So what I'd say is that figure out what you want to go solve for, and then if you have one-off recommendations too, kind of happy to go talk a bit more directly as well offline. But I mean, to that question too, like you want to understand at least from looking at a deal and operator. I think my biggest thing is like how do they get paid, right? Is like what incentives they have to go perform well in a deal. And what I mean by that is that of their compensation in a given deal, how much that compensation is guaranteed in fees versus how much do they earn for just doing the deal itself. So those are things I look at pretty extensively when kind of vetting a deal, a group, etc. Really good question so far. Okay, what are yellow or red flags you should look out for in private credit deals, whether directly lending or investing in a fund? So here, right, like people look at private credit in general. That's like saying, you know, you're investing into, how's the overall economy doing? Like, how's a business doing? Some businesses are doing great, some are not doing so great, right? Because they're private credit basically means you're lending in a private setting. And what I'd say is you want to understand who they're lending to, what default rates are, what default rates can they tolerate before the actual portfolio gets impacted. In private credit too, I like being diversified into a fund versus individual deals where a lot of deals that are done privately, there is risk to them on an individual deal basis. I think being in a fund helps kind of smooth it all out when looking at a portfolio level. So I understand how they're getting paid, who they're lending to, what kind of buffer room they have for that deal to not go to not work out, and they can still pay you back. So those are things I'd look at when kind of looking into the deal themselves as well. I think position in the stack too. If the company itself or deal itself is very over levered, there's obviously higher risk in that scenario too. Cool. Really good question so far from everyone. Can you give any thoughts on ATM investments and oil investments? So I have not made any oil investments myself, so I can't really speak to it. I have made one personal investment into an ATM fund, and that fund is not in good shape, right? That was a personal deal, no investor capital. And that was so far 0 for 2 on, or sorry, 0 for 1 in that scenario. Oil I have not touched personally. Um, Oil markets are up right now, right? So again, it really depends on what you're doing. But I'd say like anything, right, depends on who it is you're working with and kind of how they're performing, what their thesis is as well. So there's definitely groups to do it, and it might seem like they've done well, but I don't have enough context there to go have a formal opinion on it yet. And car washes, again, it depends, right? Like it depends on who it is you're investing with, the deal structure around them, the basis of them, right? I think car washes are a viable business, but again, it's really matter on, the operator themselves too. So this is a really good point here as well, is that investing in private deals, you have a massive variance, right? If you're in the public market, you look at the S&P 500, you average 8, 9% a year, right, over the last decades. In private deals, you have a massive variance going from being wiped out to zero to hitting 100% plus returns. And it's because of it's unregulated, right? There is personnel risk. These are not institutional sized deals. So all those things give you the upside, also gives the downside too, and who it is you're working with and how you're working with them in that capacity. So again, both ends of the spectrum, bigger upside, bigger downside, right? Public markets usually have a much higher floor and therefore lower ceiling too, in things like the S&P 500 or index funds. Are you leveraging AI to assist investment decision frameworks? Partially, right? I live in Claude in terms of financial analysis. We use it a lot in our private credit fund to compare data to previous fundings we've done, right? In terms of lookalikes, we're helping price certain things. So we're using it quite a bit and kind of helping us go model, make assumptions, all those areas too. I've been spending a lot of time in Claude recently. I think the modeling there is fantastic in terms of the projects too. If you're looking at deals as a whole, put them all to the same project, right, and go kind of ask the questions across the board. The more the inputs you give it, obviously, the better it gets overall. How many other sponsors are you investing with, and do you follow many others? So in terms of capital out, right, a lot of sponsors going forward, I my thesis really shifted to going much deeper versus going much wider. So when I was first starting out, especially with like my own capital only, I kind of placed it everywhere, right, to go learn, get experience. And what I found was that I'd rather go much bigger with fewer groups in terms of who it is that I'm working with, especially if I have control of them too. So for me, I've now over time it'll get less and less and less and less, and bigger allocations in those areas too. Okay, had some really good questions today too. It was great. We'll give it another sec, and we'll hop here if we got no more questions. Cool. Well, everyone, thanks again for taking some time on your Thursday afternoon to join us, and we'll send the recording here as well, the slide deck too. And any questions, feel free to reach out to myself, my team. Happy to go ahead and talk you through all things investments and what we do internally at Silverman Capital as well. So thanks again for watching, and we'll talk to you all soon.